Welcome to the Ambitious Bookkeeper podcast. Welcome back to the Ambitious Bookkeeper podcast and YouTube. If you're watching us on YouTube, welcome. I have Adrian Lopez on again. I had him on sometime last year. I can't remember exactly the episode number, so I'll just have to link it in the show notes. But Adrian I'm dubbing you my official tax expert for the podcast. So welcome back.
Thanks for having me back. Hello.
Yeah. Today we're going to discuss the One Big Beautiful Bill. Fun stuff. We'll try to keep it fun at least. And Adrian was gracious enough to come share his expertise on that and give us a little education from the perspective of like maybe what we should be watching out for as bookkeepers, how we can help our clients through this, and just flag some things for when it comes time at the end of this month, if you're listening when this goes live in January, of when hopefully you'll be sending your clients' books to their tax preparers. And you'll just stand out more if you are kind of in the know about this and you can flag some things. So anywho.
Yeah. And if you have questions, Serena, I got a couple notes and stuff I'm going through, but if you have questions about like, hey, how would this apply? Or like, hey, how can bookkeepers better keep this in perspective? Feel free to and because I don't want to be a lecturer. I want to be interactive.
It's like my own private little presentation on a CPE course where I get to interrupt the presenter and be like, well, what about this?
That's right.
All right. So I'll let you kind of take it away and maybe give if you want to give a short little background on who you are before we dive in case those listening haven't heard the other episode we did together.
Sure. Well, hello, everybody. My name is Adrian Lopez. I am a CPA based out of Sacramento, California. I'm a former IRS revenue agent. I used to be a small business self-employed auditor at the Internal Revenue Service. Now I have my own tax and accounting practice, and I love talking and learning with Serena. I appreciate she keeps bringing me back here. So hoping to teach y'all something today about taxes and the One Big Beautiful Bill. I'm sure all of you heard about it in the news. It's funny. We don't even know the acronym. Some people call it like OBBB. Some people call it like the BBB3.
Can we just call it ABBA?
We still, we still don't quite know how the acronym is going to be pronounced, and it's going to plague us accountants and CPAs for at least the next 8 years. So we'll be just kind of doing a rough overview of the one Big Beautiful Bill Act. There's some individual provisions, there's some business provisions. I'm sure a lot of you bookkeepers, you're going to be concerned with the business stuff. So don't worry, we'll get into that. Just a disclaimer, I am a CPA, but I'm not your CPA. So please always consult with a qualified tax professional when preparing folks as tax returns or if you have tax questions. So got to throw that in there. So just an introduction. What is the what is this? What is this bill? So under the previous tax regime, we had 8 years under the previous tax code or tax act, which was the Tax Cuts and Jobs Act. That was passed by President Trump. That was back in 2017. So this bill that was passed here July 2025 addressed a lot of stuff that was going to sunset. There was a lot of like little changes and nuances I don't want to say little. The TCJA actually was the biggest tax reform we've had since probably 1986. Mm-hmm. It was a big change. So a lot of that stuff was going to sunset. The has made a lot of stuff permanent, and so now us CPAs have breathed a sigh of relief and be like, okay, we don't have to go back to the old rules anymore. So we could keep our expertise somewhat constant. I will say there's always a lot of federal and state tax differences. We're still waiting to see how a lot of the states are going to respond with their income tax laws compared to how the Fed handles things. So, asterisk on that. I think some of them are issuing guidance like this month, right, in January, and people are supposed to be filing their tax returns here pretty soon.
That's always a fun time.
Absolutely. So before I dive in, I am curious, Serena, if you have any like high level questions that maybe you might want to address to your audience before I get into like the nitty gritty of it. Is there things that like you've heard or you wondered about? Want to get into specifics of things before I just kind of go through an overview? What's kind of on your mind?
So full disclosure, I have I've kind of heard bits and pieces here and there, but this year has just been kind of crazy for me. And so I've been really like not plugged into all the noise. Like I took a break from social media. I'm still off of social media and things like that. So I've heard bits and pieces here and there. And so I'm like kind of high level aware of what's going on. And I've read some summaries and stuff. I know that 1099s is always a big question mark for a lot of bookkeepers. Like there was stuff floating around, and I think they were going to have the change happen sooner, and then things changed. So definitely want to address 1099s. But other than that, I don't really have any like big overarching questions about the bill, other than basically like give us the like what's need to know on a business level for as a bookkeeper, right? Which you already know because you also do bookkeeping for clients. So this is hopefully going to be easy for you. But like, what are the kind of like the need to knows for people like me who are like, I don't, just give me the overview. Like don't dive off into all the like crazy, like obviously there's an overlap with the personal taxes for a lot of business owners. So I'll kind of default to you to like what you think is going to be like the most commonly come across things or whatever. But for the most part, like as a bookkeeper, what do we need to really be aware of to highlight for our clients and make sure that they're not missing out on things with their tax preparers?
Got it. Okay. Well, and I guess since we brought up the subject of 1099s, let's talk about that first. So 1099 reporting has been changed by the One Big Beautiful Bill prior to the previous regime under the previous rules. So you had to give a 1099, either a miscellaneous or a 1099 NEC, for anybody who has payments for services of $600 or more. And just to clarify, a lot of folks, maybe this is a side that would help bookkeepers. A lot of folks think you have to give a 1099 for payments of goods, and you actually don't. It's only services and service-based payments. So if you're receiving some sort of consideration that's a physical, tangible good from someone, you don't have 1099 for that. Just throw that out there. A lot of folks get confused about the rules, like, oh, when do I have to give somebody that? Or they're like, I have 100 vendors I buy stuff from. Like, how do I 1099?
Yeah. Also, it's like gotten more confusing over the past however many 5-6 years ago when they implemented the 1099K with the payment processors, because the payment processors aren't delineating what's a service and what's a good, right? So they're 1099ing. We just made it into a verb. They're 1099ing anyone that uses their payment processor, whether it's a good or a service. So that's caused confusion. There's also been confusion over, I still get clients of mine that are like, why is this vendor of mine or customer of mine asking for like a 1099 or a W-9 from me when like they paid me commissions through PayPal? And I'm like, they shouldn't be. PayPal is going to 1099 you. Yeah. So there's all these added layers that have happened over the last few years that have added confusion to it. However, I will say that we came across this with one of our clients. Is they had a vendor that provided goods and services. And so if something is combined, you can report the whole thing on the 1099 without like, because then it becomes confusing splitting it out. If you send the vendor a 1099 that doesn't match the total that you've paid them, they're going to be like, why doesn't this match? So just add it, just put the whole thing on there. But in general, like you said, yes.
Yeah. Only for services. That's correct. And I will say, a similar threshold used to exist for the 1099Ks, right? It was like, it was such a huge change. Everyone was like, wait, I'm going to get a 1099K from like eBay and PayPal for stuff that's like $600 or more. The previous threshold used to be, I believe it was 200 transactions in any one calendar year. Or
25,000, or was it 20,000?
Yeah. I think it was 20. 20 or 20.
Over 20K.
And so like all these, over 20K. And so all these people were like, wait, like I sell little knickknacks and caricatures on eBay and now I'm going to get a 1099K. And it's like, it's a hobby. It's like, dude, it's not a business, And so that just to speak to the 1099Ks, that threshold has been rolled back. So as part of the BBB. So now you should only be getting a 1099K if it's either more than 200 transactions in a year or the $20,000 filing threshold. So what's interesting as well is for 1099 miscellaneous forms or 1099 NEC, the threshold has been heightened from $600 to $2,000. So all those little one-time jobs and stuff that people might do for you. I mean, I know we work with construction contractors, this and that. Like you might have just subs per day. You might have like daily stuff. Like that's been moved up.
Is that effective? Now, so that's not effective for this filing 2025 season, correct? Okay, that's correct. And another point of confusion for people.
It is. Why Congress wrote it that way, I do not know.
Well,
Go
because
call
they
your
need
Congress.
more time to like change the forms and all of that, right? Whatever.
So that does take effect 1/1 of 2026. So now we can all breathe a sigh of
Nothing's
relief.
changing for this year. Do as we did last year.
Yeah.
Yes,
For
correct.
Yes.
Have to specify what year we're in. For 2025 1099s.
As accountants, we're always living in the past. Always. So that's some of the big changes. There are still some specific reporting requirements, like there's stuff for medical payments, that hasn't changed. Stuff for payments to attorneys, whether they're incorporated or not, that stuff hasn't changed. So that's all the same. It's just that for generally for 1099 miscellaneous and AC forms for 2026 onward, from $600 to $2,000, and then the 1099Ks. So for all you Square folks out there and people selling, knitting, little knitting knickknacks on eBay, hopefully you'll get a little bit of relief. I will say I used to buy and sell guitars like kind of as a hobby, and so I had to deal with this actually. This was like in 2023. Okay. Yeah. So I was like, wait, I got a 1099K. Let's know. I have to keep all my records and put on the tax return. And so I've been personally affected.
I've been personally affected. That's interesting. As a side, do you play guitar?
I do. Yeah. I play instruments and stuff. Awesome. I got a drum set downstairs. I play electric bass. I play electric guitars.
I play acoustic guitar. Yeah. And I also have a drum set. It's downstairs.
Cool. Oh my gosh, that's cool.
Anywho,
cool.
All right, back to the OB.
Yes, the OBBBA. So, I'll kind of stick on the line of sort of more business-centered provisions here. So there's a 1099K thing, which is important. There is another huge provision, I think, probably one of the most significant provisions implemented as part of this bill. It'll basically affect, I'd say, almost any business that has like fixed assets and capital improvements, that kind of thing. So there's a concept known as a bonus depreciation, which basically means for certain types of property, you can place it in service in your business and you get to write it off 100% the year you place it in service. So there's limits depending on what type of property it is. It usually qualifies for anything from like vehicles to tenant improvements in a building, cement, pavement, vehicles with some restrictions, asterisk, some restrictions. And so this was phasing down since 2023. The amount of bonus depreciation you could take was coming down. So they've reset that back to 100%. And it's nice because it's retroactive. So right now, as everybody's going to start filing their tax returns and start, getting their fixed assets together for reporting for the 2025 tax year, any property that was reinstated or that was placed in service after, I believe it's January 19th of 2025, you get to now take 100% bonus depreciation on that, which is a big deal because being able to take the tax benefit of something immediately, 100% the year that you place it in service, you used to have to spread it out. And so we call that income tax smoothing or like income smoothing. So now the fact that you can take it all 100%, I mean, there's basically tons of businesses. They might have, capital improvement, heavy stuff, a lot of equipment. For example, I have a farmer client. I mean, he bought what? I think he bought $800,000 worth of tractors and equipment in 2025. We're going to be able to write all that off. I mean, this guy's not going to pay income tax like at all. Like it's, it's a huge deduction. So this is going to be one of the most significant provisions for pretty much any bookkeeper and any tax professional to keep in mind when preparing the 2025 tax return. You want to make sure that your fixed assets and stuff's recorded, it's capitalized properly, and to the extent possible, make sure it's recorded properly so that the tax preparer can take advantage of it. Right, and use the bonus depreciation, assuming it's qualified property.
Is that different? So are they bringing back did section 179 go away? And can you talk to that, the differences between the two?
Yeah. So section 179 is still here, which is awesome. It's section 179 depreciation or section 179 expense. The biggest difference between 168. There's two big differences between 168, the special depreciation, and the 179. So the special depreciation is automatic. You have to elect out of it to not do it. 179, you have to elect in to do it. And you could do it on 179, you could do it on a per asset basis. 168K is for a whole class of assets, 3-year property, 5-year property, 7-year property, that kind of thing. That opt-in, opt-out sort of difference makes 179 sometimes makes sense more than 168K. Sometimes it doesn't.
It's like a strategic thing for the business owner. Like maybe this year they had not very much income, but they were investing heavily in equipment. They want to save some of that for future years. So they're going to maybe opt out of bonus and just opt in on some of it for 179. Okay.
That's correct. So that's one big difference. The other big difference is lost my train of thought.
Okay.
I know. Hold on. What was the other one I was going to talk about? Yeah, 179, bonus appreciation, bonus, class versus. Oh, that's right. That's what it was. Okay, I got it back. So 179 can only be used up to the extent that you have business income or like business taxable income. So it can't be used to create losses. So if you have, W-2 wages or rental income, other types of income, and you have a business that you want to say take a lot of 179 expense on, it'll only get you to zero. It won't get you negative. Bonus appreciation can get you negative. And so you can use that, like you said, say it's a business that's investing a lot in heavy capital equipment, and you're like, hey, I don't want to have any taxable income this year. In fact, I want to have a loss that I can use to offset all this other stuff I got going on. You're going to want to prioritize bonus appreciation. 179, you can't do that. It's limited to net taxable income from a business of zero. That creates really strategic opportunities for tax savings, particularly for people with rentals. I'm sure you've heard people who have like short-term rentals, Airbnbs, they have commercial warehouses. They want to get cost segregation studies done. All that bonus depreciation makes a lot of that possible where 179 doesn't. You can't use those losses. You can't aggregate those losses. You'd have to spread it out where 179, where the bonus depreciation wouldn't be there. Now that it is here, huge tax savings opportunity. I mean, massive.
Yeah.
So for all you real estate folks out there, I mean, if you have a CPA or somebody you're doing tax planning with and they haven't already discussed bonus depreciation, 168K, the cost segregation study on new buildings and stuff, you're already behind.
Yeah.
100%. So please go talk to them about that stuff.
All right. Thanks for walking us through that. It's all stuff that I learned when I studied for the CPA. And now I'm like, I have to relearn all this.
That's right. I was going to say, I mean, honestly, besides, let's see, anything else? I mean, there's qualified business income deduction, which is section 199 cap A, but I mean, bookkeepers, unless you're preparing tax returns, you won't really deal with that. Let's see. So my only other point of advice would be, you're going to want to have assets segregated on the balance sheet and recorded properly to the extent that you're giving the tax preparer the information he needs to be able to kind of choose and prioritize, okay, what makes sense for 179 versus what makes sense for 168K. And I'm sure you see it all the time, Serena, like folks don't capitalize stuff properly, or they don't record the full asset price and stuff, So I always encourage bookkeepers, make sure you're getting source documents for purchases of fixed assets and equipment, you're capitalizing stuff properly, even loan origination fees, document fees, title fees, government fees, like you gotta make sure you capitalize all that properly and be able to write that off through depreciation. So
good call.
I mean, as far as business tax provisions, that's kind of some of the big stuff as part of the 1BBB. To be honest, there's a lot of individual stuff in here for the business stuff. That's some of the big points. The 1099 reporting, the 179 expense, the 160K bonus depreciation. So we can jump into some of the individual stuff. I know you mentioned you had a lot of viewers from the previous podcast. They had like additional questions they had or wanted to bring up, that kind of thing. So I'm curious,
I don't remember any specific questions. I just remember there was a lot of feedback of like, bring him back on for part 2. So pretty much like whatever you're seeing in your tax practice, like common issues or things that you've had to unravel, that's always helpful, but especially if it's related to bad bookkeeping, right? Because our goal here is to help our bookkeepers be the best so that they stand out and help their clients as best as possible. And a lot of times people just make mistakes because they don't understand like the ultimate impact. If they're not doing taxes, like we wouldn't have visibility into that. And a lot of times tax preparers aren't sharing the feedback either. It's just, it gets lost in the shuffle. So it's not that people are purposely doing a bad job, but if we can help y'all like do a little bit better and understand the impact of things, then yeah. But yeah, if you want to go through any, like some of the individual stuff, if it's kind of tied to how it might affect, an owner of a business, that's a good thing to tackle, I think. For example, if there's anything related to like I know we have the health insurance deduction and things like that as being self-employed. If there's anything along those types of lines that are changing or have been added, investments, things like that.
That's fair. And I can't think of one provision, and this is going to be particularly important to any bookkeepers who do like service-based businesses that have tips and gratuities, service charges, that kind of thing. So you might have all heard there's this no tax on tips provision as part of the One Big Beautiful Bill Act. So under the prior rules, basically tips are fully taxable as any other compensation, and an employer would get a FICA tax credit for the payroll taxes they pay on qualified tips. So if their employees receive tips, there's a Social Security and Medicare burden on that. Employers will be able to receive a tax credit for some of that portion. So now it's not that tips are totally exempt from income tax and tax. There's just kind of a deductions allowed for income tax for qualified tips, up to $25,000 per person, unless you're, is it? Oh no, I think that even counts if you're married filing separate as well. Yeah, so I think it's just $25,000. Either if you're married filing joint or married filing separate, it's just like a blanket $25,000 amount. You get to basically back that out of what you would have for income tax. So as an example, if you have, say, if you're the world's most best paid waitress, you have a taxable income of $125,000, okay, and $25,000 of that is tips. It's actually going to decrease your taxable income down to $100,000 for income tax purposes. So for some folks, that's quite a bit, because I know a lot of folks, they have a lot of professions where it's like tips is like half their income. That's like
or more. I mean, it's been ages since I waited tables, but our wage back then was $3 an hour, and then everything else was tips, and I was probably making at least $20 an hour overall. You know what I mean? So it's like I don't remember, but it was a lot. The difference is a lot. Like tips are a big portion of the income, so that's a big deal for sure.
So I would encourage all bookkeepers, when they're doing the books and reconciling payroll and doing all that, you're going to want to keep track of in the financials for what's tips, what's being retained by the owner, and what's being paid out to the employees, because that's going to have like actual taxable impact on potentially the owner's tax return, but especially, you want to make sure payroll is being recorded properly and qualified tips are getting in there. They have to be reported on a W-2 in order to get that deduction, or possibly a 1099, like a 1099K or 1099AC, that kind of thing. It's got to be
above board. Yeah,
please make sure
we all know how restaurants work. I remember
we do.
I was waiting to.
Yeah, I've got an Italian restaurant.
Exactly. When I worked at an Italian restaurant too, and it was like they didn't report our tips as long as they were cash. We only reported credit card tips. So it's like if that's all you're reporting, but the employee doesn't know that, and then they try to go and take the deduction because they've kept good records of their own tips, there's going to be some issues.
So I always encourage, I even have my Italian restaurant client, we're moving the payroll and the POS reporting to Square. And Square, what's nice about it is it tracks all that. So it's so easy, whether it's a cash tip, whether it's a credit card tip, right? Square's just doing it. So I'm reconciling all the reports with Square every month, all that, everything's being paid out to the employees properly. It's going through payroll, the payroll tax expenses being paid. And so we feel very confident. She was asking me, she's like, do I have to do anything different? I'm like, no, it's cool. Square's handling all that. They're going to be taken care of. Don't worry. It's their tax situation, but we're giving them the information that they need. They're going to have what they need to get this deduction. Don't worry about it. So please, all bookkeepers, just make sure to keep on top of that. I get it. Sometimes the clients don't know, and that's why they have us as professionals.
Yeah, and they think they're helping out their employees by like, oh, I'm not going to report any of the cash tips because it's not trackable. But if they are tracking it with their system, but not, they shoot themselves and their employees in the foot, and they think they're doing something good, but it can end badly. So it's always good to just advise your clients and hope they do the right thing. And if they don't, you have to make a decision on whether you want to work with them. So,
That's correct.
Okay, one other note that I just realized I had too that might be related to business, because I wrote it down as a note for myself that I heard somewhere for my own taxes. But talk to me about a paid leave deduction. Do you remember hearing that? I feel like you're able to take some sort of paid leave deduction if you pay your employees paid leave. You get some additional, I can't remember what it was. It was like $2,500.
Yeah. So if I recall, there's like a paid sick leave. I believe it's a tax credit. It's like if you, because a lot of, like, for example, here in California, there's like a mandatory like sick leave provision. You have to give a certain amount of sick leave depending on how much the employee accrues. There's like another provision for, I think it's like paid sick and family leave to either take care of a family member or that kind of thing. Sometimes the employee can go on short-term disability. So there's a credit that if the employer is like, okay, look, I'm going to let this person take some time off, I'm just going to pay their salary. They're just not going to be working, but I'll pay them. I believe there is a paid sick leave and family credit that you get to claim. I believe at the federal and the state level for offering that. The only other alternative is like, they'd have to go claim short-term disability from the state and be out of work for 6 weeks. And even then, it's not even 100% of salary. I believe it's 65% salary. So something like that.
Yeah, I had a note for myself to ask my tax preparer because I do offer paid leave, but it depends on I guess it sounds like it depends on the situation. Like it's only applicable not just for regular PTO.
Yeah, I don't believe it's regular PTO. It has to be, I believe, some sick or either the person is ill or a family member is ill for the care of a family member. Yeah, it's like a family medical leave thing. And to be fair, I mean, it's a nice benefit as well, be able to give your folks, say, paid family leave, something comes up, whatever, and you're like, look, take the time off, I'll pay your salary, just come back when you can. It's nice to give the employer, a little bit of a tax break on that because it is sort of
it's almost like a double dip that they get to take because you are getting a tax deduction in general for just paying wages, but to get an additional that's right. Oh, you were a nice employer. Here's a little pat on the back.
That's great. That's great. And the governments do that a lot of times because they're like, look, it's either the employer's paying the wage or honestly, state disability has to be the tab. Someone's got to do it, So that's a good point. I was going to say too, it's not part of the 1BBB, although there is an employer pension startup tax credit that I am actually using for quite a few of my clients.
Yeah. Let's hear about it.
Yeah, so there's a tax credit. It's called the Employer Pension Plan Startup Tax Credit. And what it's meant to do is it's meant to incentivize employers to start up, 401ks and tax savings plans for their employees. So you get to, as part of the credit, you get to get a tax credit for all the startup costs of the plan. So like if you have to, go to Fidelity and have them set up a plan, there's like administration fees, there's custodian fees sometimes. So you get to get a tax credit for all that. Like I have one client we're getting it for, it's like $1,500, to establish a simple IRA for their employees starting in 25. So we're going to get her that tax credit. And then what's really nice is depending on the number of employees you have and their compensation, you actually get a tax credit for the amount of employer contributions you put into their plans. So not the employee deferral, employer contributions. I think it's up to $1,000 per employee. So like my one client, she was telling me like, oh yeah, we do matching and we do all that. And she's like, I think we have like 9 employees. And I asked, is it more than $1,000 per employee? And she's like, oh yeah, for sure. Yeah, our contributions are pretty good match. And I was just like, well, we get to get a tax credit for you now. I think the total tax credit is gonna be I think it's like 12 or 15 grand for her. And just a high level speaking out there to all the bookkeepers and tax preparers, tax credit is much more valuable than a tax deduction. Tax credit is a dollar for dollar reduction in your tax liability. So you want to prioritize credits where you can, whenever you can. So I would say, I mean, for tracking purposes, definitely bookkeepers keep an eye on that, the employer contributions, employer matches, that kind of thing. I am hoping the tax preparers know about this credit and are willing to take it or having these conversations about it.
Yeah,
they should be talking to their clients about this. In fact, California has a requirement the deadline passed by 12/31 of 2025. You have to offer a retirement plan to your employees. It's not even optional.
I think Oregon does too.
Oh, okay. So it's like this pension, startup tax credit. It's like, dude, if you're going to have to do this anyway as part of the law to be compliant, you might as well get a tax credit for it. So
yeah, absolutely. And that's just like one little note that I've discussed here on the podcast before and within my community. One of the things that we do for our clients at year end is we create a tax package, quote unquote, that they can literally just give the workbook. It's an Excel workbook to their tax preparer with all the detail of the accounts that we know they're going to need to, like fixed assets we list out and charitable contributions and all of the accounts where we know they're going to want to be able to see the detail of. And within that, we have like a cover sheet of like, here's what we're addressing in this workbook. One of the ones that you should add for this year is the employer pension credit, right? So pull all the detail of all those employer matches, add that as a tab in the workbook, put it on the cover sheet that like make sure you discuss this with your tax preparer, the credit that you have available, that you might have available. If you created the plan in 2025 or also have a match, right? Either one.
Yeah. I mean, if you created a plan, if you have a match, or possibly both, or it actually applies. I believe it applies to the 2024 tax year as well, because it's from the bill that put that into place was the Secure Act 2.0, which I think was implemented in 2023. So, all you folks out there who might have been starting retirement plans, if you haven't gotten that tax credit and you started a retirement plan for your employees,
I was one of them. I did.
Go talk to your tax professional. You can always get some money back too. I mean, you never know. 2024 wasn't that long ago. So it's funny. Speaking of charitable contributions, you actually that's a good segue. So I don't know if you remember, because I know you don't work too much with tax, Serena, but so back during COVID, I believe for 2020 and 2021, you didn't have to itemize, and you could get a certain amount of a charitable contribution deduction. I think it was up to $600 on a merit filing joint return. You didn't have to itemize. So you can get your standard deduction and you get additional charitable contribution deduction. So the 1BBB, the OBBB, has brought that back actually permanently. It's up to $2,000 for joint filers and $1,000 for other filing statuses. So you can get your standard deduction, and if you do a little bit of charitable giving throughout the year, you actually also get a tax benefit for that now. And that's really nice because, you work with pass-through entities, you work with, Schedule C sole props and all that. A lot of the times they do have charitable contribution deductions, and they're asking like, hey, how's that going to help me? And before it's like, well, dude, you didn't itemize, it didn't help you at all. Now there actually is a little bit of a benefit for it, which is nice.
Yeah.
So that's a small thing. I do believe it begins 1/1/2026 though. So it's this year. So for 25, unfortunately, it's not going to become any. But
this is one of those things that like you can also stand out with your clients is be like, this isn't, I see you did charitable contributions in 2025. It's not really going to help you much, but in 2026 it will. So if you have someone you want to give to, an organization, and have the cash for it, definitely plan for it in 2026. But it's also going to be permanent. So is what you said.
Yeah. So it'll yes. That's my understanding. Yeah, permanently provides. Yeah, permanently. Yeah. So just going forward, I know a lot of folks, like I've seen it in the books where sometimes there would be a charitable contribution that wasn't recorded as such, and sometimes those get deducted and that kind of thing. So you got to make sure you're separating that out properly.
I just had that tax conversation with someone on my team today because I was like, yeah, charitable contributions, when they pay it through the business, it's not a business deduction. So we report it separately below the line, but we do pull the detail for it and put it in their tax package so that they can deduct it on their personal taxes. If they're itemizing or what now in the future, they won't have to, but that's one of those things that like we just ensure to do that. And she was like, oh, I didn't realize you couldn't deduct those through the business. I'm like, yeah, it's not an operating expense either. And that's why we also don't put it above, we put it below the line. That's great. Because you don't need to do charitable contributions to operate.
That's great. So that's a nice little bonus there. That's part of the 1BBB. So I encourage all bookkeepers, please separate that out and make sure to highlight, because some people, I've worked with taxpayers, I've audited folks, they did tithing. They did tithing out of their business, and sometimes it's a lot. It's like 5 or 10% of their business income every month. They remit to their church. And so sometimes I've looked at the books and records and I was like, yeah, this is the tithing amount, right? And the client didn't know how much it was. They would just give the P&L, the tax preparer, oh, it just came out however it came out. And they're like, wait, is that much? So make sure, I encourage all folks, please note that in the financials so your clients can see kind of what's really happening there. Because sometimes those tithing contributions can be a lot, and it would take people back more than once. So.
Yeah.
So it's important.
Absolutely.
Yeah.
The self-employed health insurance deduction, was that a Secure 2.0 thing? And is that staying?
No, it's funny. That's been a tax deduction for a long time. And it's funny, actually, a lot of people miss it. So I would encourage pretty much any tax preparer, ask your clients, especially your self-employed and small business folks, do they have health insurance? Some states still penalize for not having health insurance. California is unfortunately one of them. The feds no longer do, but that still doesn't mean the states don't. And you get a dollar for dollar tax deduction for any self-employed health insurance that's paid for the sole prop, the person or their family. So I'll be honest, I've done audits where that was one of the first things I asked about was, hey, like you're self-employed, do you have health insurance? I'm not even seeing a deduction on here. And sometimes I'd have to adjust the deduction in the client in the auditee's favor because their tax preparer, they pay like 20 grand a year for self-employed health insurance plan from California.
And if you're not paying
it's
it through
huge.
your
It's huge.
business,
And
like
the guy's
I'm
"Wait."
not paying it through my business, so
Yeah.
it might not get caught. And even if you are, like maybe the
That's correct.
preparer just thinks it's business insurance, and so it's different treatment. So
Correct.
definitely split that out into
That's
its
correct.
own line if they're
Yes.
paying it through the business. If they're not, highlight that on their as a question on their little cover thing. If you're doing a tax package, like I am, or creating notes for your clients to give to their tax preparer, like this is how we stand out.
That's great. And it's like I said, it's usually expensive depending on what state you're in. I mean, self-employed health insurance is not cheap. So like I remember one time I saved a guy, I think it was like a $25,000 deduction. I mean, and it's such a simple thing. All I had to do is ask a couple questions. Hey, what's your health insurance? You got 1095 or something, what's going on? And he's like, dude, you're like, I've been working with a tax professional for years. You're like the only guy that's ever asked about that. And I was like, dude, I just saved you some money, dude. So, that's a very powerful deduction. You're right. Definitely keep an eye on that. That's still going on. Nothing's been changed by that. That's been a deduction for a long time. And I think it's honestly, it's only anecdotal. I'd say it's one of the more easier deductions that's missed.
Yeah, especially if like for me, like I came from corporate. So for a long time, that was never anything that I was on my radar until I became self-employed. And that's probably the same issue with your clients. Like if they worked corporate, this is a new thing. Why would they even think to bring it up? Because that's not a deduction as an employee, right? You don't get to deduct your
That's correct.
health insurance premiums, right?
Well, so as an employee, and this was negotiated under the Bill Clinton era. So health insurance premiums are actually non-taxable for income tax purposes from an employer, from a W-2 employer. So, if you made $150,000, but your health insurance premiums, God forbid, were $50,000 a year, your W-2 wage in that box one's only $100,000. You still got to pay Social Security, Medicare, but yeah, there's no additional deduction.
Yeah, but what about the portion that you pay out of your paycheck?
Yeah, that's included. So actually, fun fact, your W-2 will only reflect what you pay. It won't actually have the employer contribution on there. Yeah. So like if your health insurance costs $50,000, the employer pays 25, you pay 25, say a 50-50 cost sharing arrangement. I'm not sure it's allowed by Obamacare anymore, but don't quote me on that. So you'll only see the reduction in your taxable income on your W-2 box one of $25,000. The employer, whatever they're contributing, whatever their match is, won't actually come up on there. So I'll tell you, folks, whatever you're paying for health insurance, your employer is probably putting in more that you don't see. So it's not cheap.
Yeah, especially if you have really good plans. Like,
yeah, good PPOs and so that. Yeah, I mean, it's. I think I was looking somewhere. I think one of the cheaper plans here in California for a family of 5 is like, for good health insurance, is like $4,000 a month or $6,000 a month or something. I was like, wow.
Even if you do like the health exchange to get a good plan, I was paying I was paying close to $2,000 a month for just me and kids for a plan comparable to what I had in corporate, where I was only paying a couple $100 a paycheck. You know what I mean?
Exactly. Right. It's like, and I will, I came from the Fed. They had decent health insurance plans. And they were good coverage, and they weren't like terribly expensive. You hear all those stories about like, Facebook and Apple. They're like, oh, we cover the employee portion 100%. But yeah, government's not exactly like that. But do what you can to get some good health insurance.
Yeah.
Please.
If you're listening to this, go back to my episode with Carissa Maratino, because she is my health insurance broker and she will hook you up.
Yeah, I might need her contact information. Sure. That's cool.
Because what she'll do is like sit down with you and talk about like what health needs you have. Like if you have people in your family with any conditions that need a certain level of health insurance versus like if you're like me and I go to the doctor like maybe once a year, like you can be on a different plan, you know what I mean? Depending on your health needs. And she'll match you with options that fit your needs that are, as a self-employed individual, that are affordable. So now my insurance is way less than I was paying from the health exchange. With a plan that's very similar.
That sounds awesome.
So it's like, it meets the needs that I have, because I wasn't utilizing that whole plan. Like it would have made sense if we were on medications or surgeries or whatever, but it just wasn't the case. So
yeah, I would love to have her contact info.
Absolutely.
That'd be awesome. Thank you. I appreciate it. Let's see, anything else here? I mean, let's see. There's no tax on overtime pay. I mean, I don't know. For all you public safety employees out there, so overtime used to be fully taxable. Now it's not that OT pay is exempt from tax, but you kind of the same thing with tips. You get a tax deduction for the amount of your wage. That's overtime pay or premium pay. It's up to $12,500 of overtime pay for anybody that's not married filing joint. It's $25,000 for married filing joint folks. So I imagine all the families out there, if you got, firefighters, you got police officers, that kind of thing, security personnel. I mean, hey, being able to line up the overtime, that's nice. It helps, just for income tax purposes. You still got to pay your Social Security, Medicare on that. But anybody out there who's a safety employee, keep that in mind. Talk to your tax preparer about it, or I guess Mr. Turbo, as we call TurboTax these days. There's some stuff about the pass-through entity tax that might be a little bit above sort of. I mean, tell me, do you see pass-through entity stuff like with your clients? I mean, I'm sure maybe you do because their tax preparers recommend they do it, that kind of thing, or not too much, like in the book.
Well, it definitely counts for partnerships, but like I think a lot of people, that's kind of a conversation that happens with the tax preparer and doesn't really affect the bookkeeper as far as I know, unless we end up seeing like a tax expense, right? But as far as I've been aware, most of my clients have probably opted out of that, but also I haven't seen anything.
That's fair. That's fair. Yeah, I guess I would encourage anybody who is kind of paying a lot of state income tax or local income tax, especially here in California. Like I have a lot of clients, I'm pretty much recommending them to do the pass-through entity tax. It's crazy. They've already like not done it, and I was like, oh, they just could have saved some money, like. 12,
yeah. So then like, let's talk about that. What are the benefits? Like what is pass-through entity tax? And for anyone that listening is like, I'm clueless on this. Like, yeah.
Okay. So let me give a broad overview. We'll take one step back. So you might have heard in the news something about a SALT cap or SALT deduction, right? So SALT stands for state and local tax. So at the federal level, on your federal income tax return, you get to deduct what you pay in state and local income taxes. So under the previous regime, it was limited though. You can only deduct $10,000 a year. Okay, so like here in California, like me and my wife's tax burden for California income tax is over 10 grand a year. So we were limited to what kind of benefit we could get. So what's nice about the 1BBB is the OBBB. So it's increased that deduction cap to $40,000 now. So that means that a taxpayer who's paying up to $40,000 in state and local income tax can now get a deduction for that on the federal tax return, assuming they itemize their deductions. So itemized deduction, standard deduction. So it's gonna kind of depend. If you're paying that amount in state and local income tax, you're probably definitely itemizing for sure. More than interest, all the rest of the stuff. So when this cap was introduced, the way that states, they kind of wanted to have a mechanism to assist partnerships, corporations, people with pass-through entities, that kind of thing, in meeting their state tax burden, essentially, is they invented something called the pass-through entity tax, which means you're paying the shareholder or investor's state income tax burden at the entity level, and it flows through to them. It's a way to get around the state and local income tax deduction on the federal return for itemizing your deductions, because like I said, a lot of folks, they'll pay more than $40,000 a year. Anything above $40,000, they won't get a tax deduction for it. So pay it at the entity level, get the benefit at the entity level, it reduces your federal income tax, and then it passes through as a tax credit to the individual investor. So it's a pretty powerful mechanism. I would say, like I said, I have a couple of clients, they are paying state income tax that's well in excess of the $40,000 cap. So I'm going to recommend they do the pass-through entity tax. They get the state federal tax. They're still, paying their state tax burden just through their entity. They get a tax credit for it. It's all, it's very powerful deduction, in my opinion. It's pretty useful. And I feel bad. Like I said, she was with the previous CPA, and I'm like, dude, you were well in the territory to take advantage of this.
Yeah. So what is usually, just to simplify it for people listening, like what would trigger them to bring this up to a client, like without knowing their personal tax situation? Or is that something that you would have to be privy to? Or is it, again, something kind of like, well, do you have self-employed health insurance? It's like, along with that question, are you paying a lot of local state taxes on your personal?
I would say it might be a topic for a bookkeeper to bring up. Like I said, it delves a little bit into the tax space, so I urge caution. But if you have a business that has a lot of taxable income, and the client you have lives in a state with income tax, it might be something to bring up. For example, I've got, one of my clients here, let's say she runs a consulting business and she's got taxable income from just that entity. I think it's like 600K, and that's what prompted me. Oh, okay, I'm going to go take a look at a return, and were they doing passive entity tax? Oh, no, they weren't. I'm like, you kind of have the taxable income to kind of necessitate this, especially in California, which is one of the most onerous state income tax regimes in the nation. That's my two points. If there's pretty healthy taxable income for the entity and they live in a state with income tax, I think it's a point of conversation for sure. And I think an analysis should be done. For all you folks live in Nevada and the other places that don't have state income tax, you can take it or leave it. Unless you, I will say another mechanism of the passive entity tax is to pay the tax obligations of folks that are non-residents of your state. So, you might be centered in California, but you have a shareholder somewhere else. The entity can withhold their essentially their state tax burden for them, versus having to have them file a return and do all that. I think in some states that's even mandatory. So like the entity has to actually have some withholding.
Oh, okay. So what you're saying is like if there's an entity that was formed in Florida, for example, but the shareholders live in Arizona, California, a bunch of
places with
then
income tax.
That Florida entity should be withholding income tax.
For non-resident shareholders to meet that obligation, because they have income that's it's being sourced to a different state, because Florida doesn't have state income tax, but like California and Arizona does, and the entity gets a tax deduction.
Interesting.
For that.
Every day's a learning day.
There's some nuances. It can come in handy, especially if you're talking about businesses that have like multi-state operations or multi-state shareholders, that kind of thing. It starts to become more part of the.
Is there a number where it makes more, like it definitely makes sense or it definitely doesn't? So for example, like if your taxable income at the entity level, let's use a real life example, sort of like this might apply to a lot of our listeners. You have a client that's an S corporation, or maybe you are an S corporation, right? Your business has elected S corp status. So you're paying yourself a W-2, but your business is still like has maybe 60 to 80K in taxable income after you've paid your owner wages, right? So then you're going to owe income tax on the state level. Would it make sense for that entity to do the pass-through entity tax?
I would probably say not, depending on the shareholder situation. Like if they had multiple entities that have 60,000 to 80,000 taxable income, then you might start getting into that scenario. And here's one caveat with the passive entity tax. For example, in California, so if the entity is going to elect the passive entity tax, it has to be withheld at the highest marginal rate in California, which is I think it's 9.3%. 9.3%. So like, say $80,000 of taxable income, if you do the 9.3% rate on that, it's like 7,440. But say your taxpayer, right, at the individual level isn't paying the top marginal rate. You basically might have overpaid.
Do you get it back?
You can, or you can carry it forward. You can carry it forward as a state tax credit, essentially. So you'll get the benefit eventually, but for cash flow purposes, may not always make the most sense. For example.
And it's something you have to withhold ahead of time. So it's like we're filing right now for 2025. If we didn't withhold pass-through entity tax, it's too late. We got to do it for 2026.
See, and that's correct. So that's where California sticks as well, is you have to elect into the pass-through entity tax withholding regime by usually June 15th is usually the date. So like I already told my client, I was like, dude, we should have done this back in June 25. We can't even use passive entity tax now. We're gonna have to wait till 26, and we're gonna do it this year for 26. To get you that benefit. And like I said, I asked her, I was like, your CPA should have done this. I mean, you have the income to justify it. She's like I said, she overpaid probably by 15, 20 grand on federal income tax just because they didn't do this. It's a simple thing, but it helps. So it's a conversation to have, definitely.
As far as like on the entity level, is it something that is like easy to? It goes along with like 941 contributions like FICA and Social Security. Is it easy to just like log on and pay it? Like how do the mechanics of it work for the entity standpoint? Because that might be something bookkeepers get involved in, right?
That's correct. Yeah. So like, for example, if you're facilitating or handling tax payments for your clients, so a lot of the times you're going to have a voucher that's prepared by the tax preparer. There's a form, there's a voucher that's part of the tax return, and I always encourage ACH through my tax software to be able to take it just automatically, but some people, they do pay it manually. You'll have to go to the state tax agency website and actually pay it and let them know, hey, this is a Form 30-04 payment, passive entity tax election, it's got to be paid by a certain date. There's nuances like that. So definitely, if you have a bookkeeper handling tax payments or facilitating tax payments for their clients, you're going to want to be in close contact with the tax preparer and make sure you understand, hey, this amount has to be paid in. It has to be paid in by this date. Like there's nuances.
So that's probably something that if the tax preparer is already helped the client strategize around this, they should be sending the vouchers and the reminders when the tax deposits are due, quarterlies, basically. Okay.
Yes, and I would even go to the extent, if you're seeing state tax expense in the books, I would even go to the extent to separate it out. You have, say, your franchise tax, and then you have the passive entity elective tax. Give that way the preparer can instantly see on the P&L, oh, this has been paid. I can go in and look at the details, see what's going on, right? If you just lump it all into state tax, it might, things get forgotten, or hey, how much of that was elective tax versus franchise tax? What's going on here? So I would encourage you as bookkeepers to do that as well. That helps us on our end. Break it out. What's the normal, $800 fee a year to California, and then what's the passive entity elective tax, and being able to separate that out.
Yeah,
very useful. The bookkeeper does that, it's worth their own gold.
Awesome. Yeah, so amazing. Cool. Well, I know we're kind of we've been chatting for a bit, but are there any other big things that you wanted to tackle about the bill, or other tips and tricks for bookkeepers that you're I'm already seeing this as a potential issue this tax season?
That's a good one. I will say this is only anecdotal, because I do a lot of consults with prospective clients that either have a bookkeeper and they're maybe not happy with the service, or they kind of, they want the all-in-one shop. They want the CPA doing the books and the taxes all together. And it's little things sometimes. For example, I notice a lot of bookkeepers, they're not reconciling POS systems with the books. They'll just record net deposits as revenue. And it's wait, I got to go to the Square. I got to reconcile everything. What's fees, what's sales tax payable, what's revenue, to make the numbers jive, right? To make sure they're reliable. But I've been seeing more of that come up lately, And so I encourage folks you got to make sure you're reporting all that correctly, and get into Square, get into the thing, get the report. Please do that,
require it of your client.
As there's such
that's the other thing too, is it's easy because sometimes clients will forget to give you access or be resistant to giving you access to all these systems. Bring that up on your discovery calls of we are going to require bank access, payment processor access, POS access, because we need to be able to pull the right detailed reports without bothering you. And so it's you can ask for that.
Great. That's great. So please do that. And it's and I've seen it in a lot of audits as well, where because the IRS gets the information, they get the 1099-Ks and they get all that stuff, and then you try to go to the books. And I tell you, where the books were reconciled, which is rare, I'm going to be real with you. When the 1099-K, Square, and the books did not match, that was pretty common. It instantly made me a little more skeptical of, okay, are these books that reliable? It's a small thing, but it matters, especially in an IRS examination. And then vice versa, right? When I had Square, the books, bank deposits, everything was matching. The P&L matched to the penny. Oh, it's beautiful, because it's just okay, now I know these guys have done a good job. This whole package is just a little more reliable. Sales tax ties out, Square ties out, bank reconciliations tie out. Everything's been reconciled correctly. I know you and I talked about it in the previous podcast. It's this whole picture perception and perspective. It matters. The whole package has to be reliable, or else the IRS can question things. Well, why is that like that? Why is that like that? Or hey, we straight up don't believe you. This is incredible. This is incredible evidence. This is incredible testimony. The books don't show this. Huge factor in whether you owe nothing or you owe a lot.
Yeah. And then just the other side of the purpose of reconciling that, not just for tax audit potential, but when you don't reconcile the payment processor and the point of sale and all of that, if things aren't reconciling, likely your client's not getting all of the money that they should be getting. That's usually the issue. It should reconcile. There's always going to be deposits in transit and things like that, but you should be able to identify them. That's one thing that we've had a really difficult time getting all of that to really tie out with Shopify whenever there's 5 different payment processors, because you start adding all these things, it's really hard to trace, like, okay, well, why is there still a balance in here? Like, because we have to use clearing accounts and stuff. And Shopify makes it really hard to see like where the fees are coming from and all of that stuff. So it's like, there's definitely like some challenges with that. But the reason, you have to do that work is to ensure that like this was what was sold. This is what the client is owed, and you're putting your faith in a payment processor, and sometimes they screw up.
It's funny you bring that up. I work with a few different payment processors, for some of my different trades clients and that kind of thing. And seriously, you're right. The reports like aren't accurate. Like they say they took this fee on this day, and then it comes up at the bank like 3 days later, and you're like, wait, dude, I already journaled this. This doesn't even match. It's not even the same amount, the same day. It's crazy. So truthfully, do the reconciliations, please. Get in there, because sometimes and you have to go hunt for the answer, because you're like, wait, what the payment processor gave me actually doesn't match. What happened? That was surprising to see.
I mean, that happened in my corporate days. We used like, I don't remember what payment process. It was like a credit card processor, because we had like a physical store, but like that was part of my job, was to reconcile the actual deposit hitting the bank and anything on their statement, like making sure that whatever wasn't in the bank yet was just in transit. And then we'd verify that it came in the following month. And it's like, there was times where the amounts were $50 off, $100 off. And I literally had to call the payment processor and be like, why? And they'd be like, oh, whoops, that was a mistake. You're right. You were owed that money. Exactly. I don't know what happened. It's like
this is why reconciliations are so important. It's small things like that, but it's like, for a business, those small things add up. It's true.
Yeah, for sure. Yeah. Well, thank you again for coming on and chatting with us about tax and how we can be better bookkeepers and help our clients more and bring things to light and stand out. I hope if you were listening to this, you found it valuable, and comment below the YouTube if you're watching on YouTube any questions you might have for Adrian, and this time I'll make sure he gets them. I'll go back to the old video and field some questions to see if there's anything lingering. But yeah, thank you so much for taking the time to come on here and chat tax with us. I really, really appreciate it. Selfishly, I like to be able to just have the conversation.
Absolutely. Thank you for having me. I enjoy our conversations.
Awesome. If someone wants to connect with you, reach out, maybe refer a client to you or whatever. Are you taking tax clients still? What's the story, and where can people connect with you?
Yeah. No, I am. I'm actively taking on individual business tax clients. And Serena mentioned I'm a one-stop shop. I do books and taxes for folks. Personalized white glove service. The best way to reach me is on my website, www.anlcpa.com.
Awesome. I appreciate you so much, Adrian. Thanks for coming on.
Absolutely. Thanks for having me.
We'll talk to you soon.
Thank you to everyone who helps make this podcast possible. Content and interviews are produced by me, Serena Shu. Our intro and outro music is written and performed by my brother, Ian Gilliam. Editing is also by Ian, using his awesome sound engineering skills along with Descript software. Hosting and publishing is by Buzzsprout, and you can check out the show notes for links to all of these amazing resources and resources mentioned in the episode.
Be ambitious.